In this session, we're going to understand one of the most important financial statements in accounting, the balance sheet, or as it's called, the statement of financial position. By the end of this session, you will understand what the balance sheet represents, the accounting equation behind it, the structure, the main items included, and how a balance sheet is built step by step. A balance sheet shows the financial position of a company at a specific date. Unlike the income statement, which covers a period of time, the balance sheet is a snapshot. It tells us what the company owns, what the company owes, what belongs to the owners. In simple terms, it shows the company's resources and how those resources are financed. Everything in the balance sheet is based on one fundamental rule: assets equals liabilities plus equity. This equation must always balance. Let's understand each part. Assets are resources controlled by the company that will bring future economic benefits. Liabilities are obligations, amounts the company owes to others. Equity represents the owner's interest in the business. If we rearrange the equation, assets minus liabilities equals equity. So equity is what remains after paying all debts. This is why it's called a balance sheet. Both sides must always be equal. Let's break down the structure of a balance sheet and go through each section step by step. Assets are resources controlled by the company that are expected to bring future economic benefits. First, we have current assets. These are assets expected to be used, sold, or converted into cash within 12 months. Cash and cash equivalents. This is the company's available liquidity, cash in bank, petty cash, and short-term deposits. Trade receivables. These are amounts owed to the company by customers. In other words, sales made on credit. Inventory. This represents goods held for resale or raw materials used in production. Prepayments. These are payments made in advance for services not yet received. For example, insurance paid up front. Next, we move to non-current assets, sometimes called fixed assets. These are long-term resources that will benefit the company for more than 1 year. Property, plant, and equipment. These are tangible assets, for an example, buildings, machinery, vehicles, and equipment. Less accumulated depreciation. Depreciation reflects the wear and tear of those assets over time. Accumulated depreciation reduces the carrying value of the asset on the balance sheet. Goodwill. Goodwill arises when a company acquires another business and pays more than the fair value of its net assets. Total assets. When we add current and non-current assets together, we arrive at total assets. They are everything the company owns. Now let's move to liabilities. Liabilities are obligations the company owes to external parties. Current liabilities are debts that must be settled within 12 months. Trade payables are amounts owed to suppliers. They are purchases made on credit. Creditors under 1 year are short-term obligations such as tax payable, accruals, or short-term loans. Total current liabilities. When we add them together, we get total short-term obligations. Non-current liabilities are obligations due after more than 1 year. Long-term debt includes bank loans or borrowings that extend beyond 12 months. Creditors falling due after more than 1 year include long-term obligations such as lease liabilities or deferred payments. Total liabilities. When we combine current and non-current liabilities, we get total liabilities, which is everything the company owes. Net assets equals total assets minus total liabilities. In other words, once we subtract everything the company owes from everything it owns, what remains belongs to the shareholders. Equity represents the owner's interest in the company. Share capital is the money invested by shareholders in exchange for shares. Revaluation reserves arise when assets are revalued upward. The increase is recorded in equity, not profit. Retained earnings are accumulated profits that have not been distributed as dividends. When we add these together, we get total equity. Total equity must equal net assets. If it doesn't, the balance sheet doesn't balance. So to summarise, the balance sheet shows what the company owns, called assets, what it owes, called liabilities, and what belongs to shareholders, called equity. In the UK, we often present it as net assets equal equity, but mathematically, it always comes back to the same equation. Assets equal liabilities plus equity. That's why it's called a balance sheet, because it always balances.